Spanish bond yields reached nearly 7%, a new high for the Eurozone country. Nokia announced 10,000 new job cuts and reduced its earnings outlook for the third time in little over a year. Stocks have been in a range for the sixth day in a row, and traders will be looking for a resolution. I'm Taylor Schrantz, and the morning call starts right now.
Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with The Street, and together we bring you the morning call. This morning, Moody's cut Spain's ratings on their bonds. The Italian bond auction, their yields went up. I mean, Europe is just a disaster. And this weekend, we're going into the Greece elections and the G20. How are you setting up?
It's just very worrisome where the only potential positive news out there is stimulus. The only positive news that people are hoping for that could help save us is just more, good money after horrendous money, or now bad money after garbage. But besides that, the problem is that there are a lot of problems and they're very complicated, and the solutions that we've put in place, or the powers that be have tried to, haven't really worked. So do they want to stay on that road, or do they want to change paths? But when you change path or you go in a new direction, it's always hard. And Europe tried to go down the path of austerity. They tried to go to a commitment to debt reduction, and they pretty much abandoned it about a month ago or so when Hollanday came in and said, okay, we're going to go back to tax and spend. We're going to start charging companies for firing people. We're going to, lower the retirement age. And Greece and then says, okay, we have a great package of aid, but you know what? We don't want the austerity, and we want a better deal. And no one in Europe has the backbone to say no or give tough medicine. So everyone just keeps giving in, and it's becoming this, story that just doesn't go away. And for us, unfortunately, we have to deal with it, but everyone deals with it differently. But at least we're trying to put together some type of plan.
And it has been a lot of news, and the market's been up and down, but it's been trading in this tight range for the last few days. Which way is it going to go?
Well, that's a billion-dollar question, or trillion. We talk in bigger numbers these days. But you did have, if you look at the chart of the S&P, there have been calculated patterns to trade against. The first one, the very bearish one. You had this head and shoulders top pattern that may have indicated, or maybe it was forward-looking, that we're going to have a lot of these problems. And then when we broke this 1360, you had that move lower, where a lot of my guys are in cash. A lot of people that watched the morning call, they felt pretty good about themselves. And now, we have a new pattern here. You have this inverted head and shoulders pattern where you have the left shoulder, the head, the right shoulder. This is when, we broke through the 200-day, reclaimed it. And right now we've been holding higher. There's been some commitment. Commitment from who? I don't know, but a lot of times we don't know who's actually buying. It could be the Fed, it could be the conspiracy theorists, whatever. But here you are, off the low, so people are trying to figure out, was this the low of the summer, or, and is this a bounce to be sold? Do we have another level in front of us here? And at this point, I don't think anyone really has the answers. For me, I'm being very tactical. It's been a very choppy last 5-6 days. Guys trying to buy this high here, not getting rewarded. People trying to short for a retest have not been rewarded. So once everyone starts to get frustrated enough, that's when the range gives out. So right now, have a defined plan. Below this 1306, 1308, perhaps we start to, come right back down, and then we test where we gapped up on that day, right around here. You could write down like 1295. Then you have the 200-day that's moved up to about 1290-ish, and then you have the lows. But if all of a sudden, they think that Greece is going to be bailed out, they're going to stay, they could kick the can down the road, and no one has the staying power, we have capability of breaking above 1330, and we break above 1330. If you're short and uncommitted, you probably cover. If you're thinking that the lows are in, the U.S. markets are going to be the place to be, you can get a move to the 1360, which is the retest here. So right now, it's a very, very complicated environment. It's not easy to make decisions. I still think cash is king. I still think that the market's going to be here, and you want to just be a bit more safe, prudent, and not a hero. So for me, I'm going to be very tactical with no big thesis.
Yeah, it's really been tough to pick stocks in this market, or trade stocks in this market. In the sector spotlight, we're going to take a look at some of the consumer stocks. There have been some that have done pretty well despite getting others being beaten up, and some that you can buy on the pullbacks. We're going to talk about some of the names Stephanie Link at Action Alerts Plus likes, as well as some others. We'll start with McDonald's. McDonald's yesterday got downgraded by Goldman. The question might be, where were they at $100? This stock has been beaten up. It's underperformed the market. It's underperformed peers, but they have a gross margin story expansion there. earnings should still be growing at mid-single-digit growth. Stephanie Link, she started a position in this last week, and she bought it yesterday, and has been building the position.
I think with these high-quality names, some people get lulled to sleep and they just think, I'm just going to buy and hold them. And they don't have to like tactically sell, have high-level stops, have low-level stops, because if you do so, you can always get back into a quality name at the right time. So it's good that Stephanie's actually buying this dip versus chasing the excitement of it, or whatnot. And as a trader, we talked about McDonald's, I think, more times than I've talked about it this year or in the past few years, and they were all like sell setups. If you look here at McDonald's, you'll see, I remember this gap down, and I said, you know what, first time I've seen McDonald's gap down in a while, let's see if they could fill the gap. It filled it somewhat. There was no real power here. It never broke back above this somewhat downtrend. It tried a few different times because everyone's like, oh, it's McDonald's, it has to happen, and it didn't. Then finally it intensified to the downside once it broke this area, which was like 94. So if you didn't sell it into this scenario here, this was your spot to sell it right around 94. And if you did so, you then got out of the way and you saved yourself some pain here. So now at this lower level versus 86, here it is. This low here is about 85.92. If you want to get into a tier 1, it's okay. I think over time you'll probably be fine. If it starts to then get above this lower pivot, that's when some traders will probably jump on around 89. But again, if 1307 on the S&P gives out, you're going to see this level here give out, and then your next level underneath on McDonald's really doesn't come into play until down here at what is this level here? About 83.74 or like 82 to 83. So if you're looking to buy McDonald's and you're not involved, I would do a tier 1 feeler here. Then see if we can start getting in motion the right way. If not, and it breaks this, this could be the better level. So don't go all in here at McDonald's, but it's worth a feeler down here.
A defensive play might be CVS. They're 100% domestic. Stephanie's been adding to this position. They're taking share from Walgreens. They've got a whole debacle going on there, and they've got a restructuring program underway. So trading at 12 times versus its historical multiple of 15 times, it could be an opportunity and a safer play in the consumer space.
As I look at this chart, it tells me something fully different. It's above the moving averages. It's been a chosen one to be held up by institutions. If you look here at the stock, it's not, you're not buying the dip here, but investors haven't been caught in the correction like in many other spots. And you have predefined support here. It's well above the 200-day. It's above the moving averages. It's a bit choppy in here because again, the market's not just letting stocks break out. This was the last time it had a really clean breakout right around here, so it shows you that it could happen and it could be clean. And since then, since what is that, March, April, almost 4 or 5 months of consolidating up here. So for this, I would say 2 ways to do it. Have a high-level stop and be ready for some momentum. If you want to buy it here and you're not committed to CVS, I think buying here makes sense. It's a candidate to break out, but this would be your stop, 43.30. And as a trader, if it could finally get a little momentum, I think some guys will look for it for a clean type move above 45.70 for a breakout, kind of like when it cleared this level, you actually could have made money as a trader. So as an investment, I think that it's acting very well in this environment. You have predefined support. Here's where it would go in motion for new highs. So I do think this is in the game and a good pick.
eBay is another. They've got a great fundamental story, but it's been trading in a tight range. When's that going to find momentum? What do we need to see?
Well, momentum is like the key word, because especially in high beta tech or in technology, there's really none of it. Things are holding in there, and I think that's like a win lately. And eBay is on my list. If the market does want to rally, this will be one of the chosen ones. If you look ever since earnings, it's held up really well. Okay, this was the earnings gap, and there's a lot of people that are still accumulating this above this gap. So when you hold the gap like this, you have shorts trapped and you have pent-up momentum. People aren't even letting it come in, not waiting for it to get on sale, so to speak. It's above all of these moving averages, so it's showing you accumulation. I would say a short term. Yesterday was a bit of a sell signal where guys that were trying to play for a potential breakout above resistance gave in on it. So it's still in the middle of this range. I would say as an investor, just being tier 1, because I don't think you should be in anything more than a tier 1 in anything right now. This is investment quality. And then if it gets in motion, you go in for a cash flow trade above 42, if that's the place, and that's where traders will probably step in and buy it, to get it in motion. So at this point, it is investment quality. You have predefined levels here. This is your big support. And then at some point, if this market gets a little bit better, this will be a new high candidate breakout.
Let's take a look at American Express. This stock got beat up yesterday. It was down almost 2.5% in a a little bit down market, but I think that was something to do with the weaker than expected retail sales that came out yesterday. What are you seeing in the charts? What levels do you watch?
I think, again, this is a good example on during corrective phases, even stocks that act well, you have to have high-level stops and low-level stops. High-level stops when the stock changes complexion and gets weaker, and low-level stops when you try and buy a stock that just isn't ready to be bought yet. So if you look here at American Express, you will see that it looked really end of April, it still looked as if it was strong. You had this nice trend intact, and then it tried to break out and couldn't. And this move down was pretty harsh, and it happened quick. So those who were looking for momentum when it broke above this area, because this was the prior high, should have sold once it broke back below. We talk about if you play a stock for momentum, above momentum levels, if it gives it back, you get out of the way. It's one of the Red Dog rules. But anyway, you have also this little uptrend that was broken within this pattern here, and it's corrected. And now here, I don't really know, to be honest. It looks very, very choppy. Looks like a lot of indecision. Here's your defined resistance, so you could have that in place just like the market. And here's your defined support. This is very choppy. Red day, green day, red day. It just shows indecision. The market doesn't know if this move off the highs was enough, so I think that you don't need to be big here. If you did sell it into this area and you want to test it, I think it's okay, but I think high level, 54.87 is your stop. If it breaks below this, some guys probably will think about shorting it, and then you could get a move down to this 200-day, which would be like a little bit more of the gradual uptrend versus the accelerated one that broke. So really about 52 would be a better entry. And if it's at 52, you probably see the market also below 1307, 1308 in the S&P.
So those are some takes on some of the consumer stocks. We're going to take a quick commercial break and get back into it with the banks.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Jamie Dimon testified before Congress yesterday, and the stock was up 1.5% after that on the news. Jamie Dimon was cool as a cucumber, and he supported some smart regulation, but he held his opinion.
I laugh because my mom used to say, so after temperature, she'd go like this, no, you're cool as a cucumber. I'm like, all right. Anyway, he was cool as a cucumber, and the stock reacted well. And it actually pushed through the resistance that was in place in this lower pivot. So it just shows you that these defined levels can be great for action. It was a great long early in the day, and then it lost some of that momentum. So there were a few things to learn from JP Morgan yesterday. One, the other banks really didn't go with JP Morgan, so it didn't confirm that it was going to help the market. And two, it tried to break above resistance and still is not strong enough for that. So if you look at the chart here of JP Morgan, you will see, here was the day when they announced 4.2 versus 2 billion. That was a nice buyable day. Since then, you had to move back to almost 35 and change. So this is a nice type of calculated cash flow bounce. It tried to get above this 34.44. It squeezed a little bit. It filled the gap. I've talked about this gap a few times, and then couldn't really get above it. So at this point, I would say let it go sideways. If it holds above, I would say this new little pivot here of about 33.60 and continues to make higher lows, low, higher low, another higher low. Perhaps it keeps working its way back to the moving average here at 36 or so. But at this point, it's still not, you're not getting rewarded for buying any type of strength. I would just say as long as it's not a big time headwind, just keep an eye on JP Morgan. Maybe after this, it'll be out of the news for a little while.
Hopefully, right? Goldman Sachs, now this one's below a number of key moving averages. So has this one bottomed, or could there be more downside?
I think there's more downside here. And lately I've been I chuckle a lot when I listen to their calls now in the market. I hate to say it, but they said generational buy at 14.15 in the S&P 2 days before the correction, and then the Monday before the actual big rally on Tuesday when we were at 12.80, they're like, okay, now we're going to lower all our estimates, and they probably scared more people out of their stock. So they impulse people to buy at 14.15, and they probably impulse people to sell at 12.80. But anyway, as far as the stock's concerned, I just showed you the chart of JP Morgan. You saw that it tried to break above its lower pivot. So if you want to put a lower pivot here on Goldman Sachs, that would have been the same thing as Goldman Sachs trying to get above this 96.75 or 97. Look what it did yesterday. It did nothing. It didn't participate at all. So to me, I think there's still more downside. You have big time support here going across below 90. So if you look, I don't see any compelling reason to be a buyer here of Goldman Sachs besides the fact that it's coming into some big intermediate support. So I would say if you're long it, be long it versus 89.90 or this 90 area. But if things intensify in the banking area and we go a lot lower, this can see why not 76 or so. So at this point, big correction to the downside. Hard to short or hard to sell here now, but I don't think it's a macro buy yet.
How about Bank of America? This stock has actually been hanging in there a little bit. It closed yesterday at $7.50. Can it get to $8?
Can it get to $8?
We're back to 10.
Right. Well, it was a good vehicle this year, and you have to time Bank of America. And if you ever add on strength, typically you do get a little punished. If you look here at the chart, I see a bit of a better pattern. Okay. First of all, we had a lot of success with this stock because it trades in tight patterns. I don't care about their problems, but remember here, I remember saying if it gets above 815, we're going to have a nice move, and pow, look, all the way up to 10. This is also a good example on how you have high level stops also. Stock was going sideways. It looked like it was trying to base, kind of just like it did here, but this time it didn't go to the upside. It broke to the downside. So if you had a nice stop here at 930, 935, you saved yourself a lot of this pain. So at this point, you have somewhat of a bottom here into this zone, into like a little bit above 650, and it's still very choppy. It is holding this last up move. I would say this is decent for clues. If the market wants to break higher out of that range, this can break above this 770, but I don't see much more than like 812 to maybe even 850, for the short term at least. So at this point, it's on the radar. A lot of people, I feel like investors, since they don't like the volatility and they like cheap stocks, they turn to this one, not even caring what goes on behind the scenes. So this one, above that level, I think there's a trade there, but I'm not rushing or enamored into it because to make money, you have to buy hundreds of thousands of shares. But anyway, let's go back to
Morgan Stanley is a loser yesterday. It was down 2%. This stock is, it has that impending downgrade by Moody's coming. We won't get that until the end of the month. We've been avoiding this stock. Do we just continue to avoid it?
I think if you've avoided it and you're not involved in it, there's a trade here also. This chart actually looks a little bit like Bank of America, and it'll probably be a little friskier if it does decide to move. If you look here, you'll see that you have a wedge type pattern that's setting up, so at least it's tradable. Okay, it could be tradable both ways. Here was that low that was set in, okay, right above 12. It's holding a bit higher. So for this one, without knowing about the ramifications of the downgrade or potential backlash from Facebook, this and that, if it gets above 14, there's probably some room to fill this gap right around here in the 15 area. If you sold it correctly in this mess, this could happen. But if we turn lower, this little wedge could be set in motion to the downside. So I would look to be a short here below 13.15. So right now, I don't think you need to have a thesis on Morgan Stanley except for it's nice and tight, and it's either going to bounce with the market back to this area or it's going to help lead it lower. So, watch those levels and trade accordingly.
Let's fly through some quick hits. Let's start it with Apple. This is obviously a key indicator for the market. Has it lost its momentum, though?
On event day, they sold it. And it was actually a good short. Most guys were looking for that. I think I even tweeted at 159. I'm like, don't be all in Apple. They'll have to sell the event. So it was a good trade when it went below 580. And then, Goldman upgraded it right after that day and with their 850 target. But anyway, right now you have defined levels. I think it's also going to give us clues for the market. The longer that Apple stays below that 579 to 580, I think the more people are going to try and short it. If it gets below here, let's just go right to the chart. Might as well show you here. Here's an outside day. This is a short-term sell signal. That's what we had in Apple on event day. In order to negate the weakness of that day, you have to reclaim it very fast. And so far, we haven't. It still hasn't reclaimed more than 50% of that day. Yesterday, my buddy Evan Lazarus on the Twitter feed, he was shorted versus that level, and he did pretty well. Now I think guys are going to say, okay, if it can get below 570, could be worth another scalp short. And if it gets below 560, 670, then it could, the market could be in for a bit of trouble, because you do have a bit of of an uptrend right here, that if it wants to break below and retest the 100-day and the market wants to be weak, there is a potential short-term move that could take you to about 556, and that'll be something to watch and trade and make money on if that's the case.
Let's take a look at the levels on Facebook.
Facebook. My traders love to go after that. It's almost like a drug.
Yeah.
And I trade it also, and there's a little bit of money there, but it's still heavy, and it doesn't seem like it still wants to bounce. And if you look here at the chart of Facebook, don't have a thesis here. Don't think it's Facebook and it has to be $50 one day, because it doesn't. All right. A lot of people thought that on this day, and look what happened. Every time it's tried to put a little pivot in, it's resolved to the downside. We had a few little red dog reversals in here. This one day was a decent action area and then got hurt the next day. This was a decent action area as it made a new low, came back above it, but choppy. So at this point, you could see a small rising or ascending channel here. So it's almost like another big bear flag. So here's your pole. There's your flag. Can't even take back 20% of what this move to the downside was. So I would say below 2680, guys are going to try and short it again. And then you have the low here of 2550 to trade it against. At this point, a lot of people are losing money trying to trade this thing. It's not that compelling.
Caterpillar's been really beaten up stock. Is there a trade in there here at 85 and change?
Every trade in there has been very short-lived, unless you're just leaning on it short. And people hate to lean on it short, especially after a big move like you saw in Caterpillar. But again, it doesn't matter what name it is. You've seen corrections in a lot of these key stocks, like JP Morgan, even McDonald's, Caterpillar. The more I look at a lot of these broken charts, the less actual conviction I have to be long stocks, because I see no leadership. I don't see anything worth sinking my teeth into, except for some type of reversal trade that hasn't led to anything. So if you look here at the chart of Caterpillar, you will see that the only thing it has going for it is that it's pulled in a lot, but it's still below all the moving averages. This was still an area to get out when it broke. If you missed all these sell signals, this was a major momentum area. This is where it had a prior breakout and it couldn't hold. That was your sell signal, as well as when it broke below the 200-day. We talked about that. And now it's setting up a lower pivot. It makes it hard to short it all the way down here, obviously, but it doesn't necessarily mean it's a long yet. Typically, these type of wedge patterns continue to the downside. So I would say if you're in it trying to buy it, this is your stop. Your stop is 84.67, and then you actually have it's just say this area. If it starts breaking below this, you know that this market is that weak. If the market wants to rally, and there's always an if, here's your little downtrend, because these all have predefined levels on the up and down side above, what is this, 89.46 or so. Then you could get a bounce in the works, and that'll help the market. So right now, keep this on your screen. It's good to have Caterpillar, McDonald's, the big name stocks on your screen, so you can figure out direction of the overall indices.
It's always good to watch the big names, and we talked about the levels in the S&P 500, some other key stocks to watch, and check in at the end of the day with Scott and the T3 Live team for their daily recap.